Hi, everyone. It's Deontay Chantel from the Journey to Develop Her podcast. Today, we have a special guest, Mr. Donahue Peebles III. How's it going today?
I can't complain. Life is good. How are you?
All is well. We're so blessed to have you on today's podcast. We did have the opportunity of chatting probably 2 years ago about a deal in Cleveland, Ohio.
Mhm.
So, just I just want to say kudos to you for being very diligent in your progress as a developer and also looking back to pull people up with you as you and your dad build this real estate development empire. I do appreciate that personally. Um, Taking the time out in the past to even have a conversation with me. And today we have you on the podcast. Just so you know, Journey to Develop Her is all about my real estate development journey. We do interviews with other developers as well, women and minority developers, but anybody that's going into that space. So again, it's a pleasure to have you on here. So I'm gonna let you introduce yourself briefly to our audience.
Sure. Well, good afternoon, everybody. My name is Donahue Peebles III, and a second generation real estate developer. My father founded a company, the Peoples Corporation, in the early 1980s, focusing on public-private partnership. We've done several billion in development over the past 4 years. In 2017, I founded an affordable housing development company called Legacy Real Estate. We have about a $500 million pipeline and are based down here in Miami Beach and scattered throughout the Eastern Seaboard as far north as Boston.
Awesome. That's incredible. So a lot of the individuals watching the podcast, many of them may be new. Um, some of them are experienced, some of them are seasoned. What are some of the ways that, first of all, I think I heard you on Clubhouse. That's when I first discovered like who you were and what you were doing. So that was about 3 years ago.
Do
And I
people still
received,
use Clubhouse? Should I go back on Clubhouse?
they are, but not, I don't really think about I don't think in the real estate space as much, but they are using it for different platforms to educate. They are.
Okay. Gotcha. Yeah, I remember during COVID, this was peak COVID, and folks were so starved for social content and to create meaningful connections that Clubhouse was at least for like a 5, 6 week period level really.
Yeah.
It was like the end of the year 2020.
Yeah. It was fun. We learned a lot. You was pouring on there, you and Brandon Rule and some others.
That's right. I was on the Invest Fest panel with Brandon and John O'Brien.
Okay. Nice. That's incredible. Yeah.
But
So
I interrupted you. So what was your question?
well, I remember hearing a segment you were speaking to the fact of structuring real estate development deals. I believe it was called The Art of the Deal. I don't know if you were trying to start a podcast at the time. Not really sure. But let's actually talk about how newbies and or seasoned investors or developers can structure partnerships for development.
Okay.
If you can give any pointers um, in that regard.
All right. I like it. I like not into no pleasantries, just right into the nitty gritty. Okay. I actually think so. Real estate as an industry is founded on partnerships, and the partnerships are relatively atypical because they occur over an extraordinarily long period of time. They come in with a plan, but the fundamentals of the plan remain intact. But a lot of the moment to moment decision making is variable and imperiled by outside circumstances, right? So that's maybe my Ivy League way of saying that they happen for a long time and circumstances change. And so when I think of real estate joint venture partnerships, I think of them a lot like good relationships and good marriages. They're founded on trust because, in large part, it's impossible for a document to conceive of every permutation that a real estate deal can take. And when you're in a partnership, you have to consider what it's like to collaboratively solve problems and pursue outcomes. Um, So the first thing to care to think about is who you're partnering with, right? Are they someone you know well, whose track record you're familiar with? Are they as familiar with the asset class, the investment thesis, and the type as you are? What are your respective benefits that you're bringing to the table? Again, a lot like a marriage, right? What is your partner bringing to the table? What are you bringing to the table? How are you going to combine those two sets of resources in order to create a sum that, or in order to create an output that's greater than the sum of its parts? Um, when we think of partnerships, right, in real estate, we divide them into two primary categories, right? Co-GP partnerships or general partner partnerships, and then there's limited partners. Um, Ordinarily, your limited partners have a much smaller role. They're capital partners. They take equity risk, but they're not involved in the day-to-day decision making of the asset. Uh, Whereas your general partner, your co-general partner, uh, is also taking equity risk, a lot of times risk that's greater than that of the limited partner, depending on the structure of the partnership and how capital is distributed between those two tranches. Um, but that person is working alongside you to determine the best path for the asset and is managing the day-to-day aspects of the business model. Now, in both of those sets of partnerships, just like in marriage, one of the things that I like to focus on a ton is dispute resolution. Is when we do disagree, right? How do we resolve those disagreements? Particularly, pardon me, because
Bless
real estate investment has a time component, right? It's how much money we can make, how quickly, and to the extent that in a partnership we have a disagreement and that disagreement is protracted, everybody loses. The second thing I think about, right, and again, very, very similar in large part to a marriage, is how we're making decisions. This is true both when you're allocating roles and responsibilities in a household, in a general partnership, or between general partners and limited partners, right? Um, who's going to be doing the dishes? Who's taking out the trash? Who's paying the cell phone bills? Who's paying the mortgage? Right? Who's responsible for overseeing construction, for securing capital, for putting in your draw requisitions? Who's responsible for the zoning entitlement, free development, for corresponding to the architect? Right? Understanding those roles and responsibilities, and then what decisions each individual is able to make unilaterally. Right? Certainly, most of us, if we live with our significant other, would be a bit upset if their significant other went out and bought a house, but probably wouldn't be so upset if they went out and bought a new brand of beer to put in the fridge. So understanding where that dividing line is in a partnership, what decisions need to be unanimous, what decisions require majority approval, and what decisions can be made unilaterally by your lead general partner is important. When there's too much nuance and too much consensus, deals move slowly and decisions are hard to come by. And when one partner is unilaterally empowered to make all of the decisions without the appropriate checks and balances, there's oftentimes ample room for discord and sort of discontent. And so you have to find that middle ground very much in a partnership. And that's why, in large part, they're based on trust.
right. No, I listen, okay. I've had some partnerships on smaller projects, and it is a marriage. And sometimes you have to get a divorce, unfortunately, right? I don't plan to get divorced when I get married, and who does? But it can go either way. So, what are some recommendations to protect, especially a newbie developer who doesn't know anything, who can be vulnerable and be taken advantage of? What do you recommend that they do to be protected in
Oh,
partnership?
that's a good question. That's a good question. I think the truth is that um, if you're new at this, it is not an excuse not to be educated as to how the process works, how the deal works, right? In large part, real estate development is not complicated. And a lot of the information that you need in order to really understand your risk in the process is publicly available. Um, I think if you're a newbie investor and and you're investing with somebody else, you need to be very, very clear on what their track record looks like, what their past performance looks like, how their experience, what their experience is with other partners in the past, and what role you're expected to play. Um, are you come into the partnership with the land? In that case, you have a ton of leverage, and you need to be able to structure a partnership that ensures that you're appropriately represented, right? That means you need to have decision making rights, the ability to oversee the aspects of the project that you're not necessarily responsible for. It means that you need to have very robust dispute resolution language that can protect your position to the extent that you're required to contribute capital, but maybe don't have very much of it. You need to understand what the member loan structure looks like, what the dilution structure looks like in the event that there are capital calls that far exceed your ability to fund them. And who gets the right to make those capital calls and how, right? Who gets the right to make these distributions and how? I think that if you're in a limited partner role, um, and you're a newbie, it's a much safer place to be, but you gain a lot less experience. But then it comes down to the quality of the sponsorship. So who's leading the development? What does their track record look like? And ultimately, what are you hoping to accomplish with the deal?
That's so good. That's great sound advice. And I think that will listen to the podcast. And just let me take a step back. This is a podcast educating, if I didn't say that before. So there's some people that might come on here as a point of reference, right? We're also a nonprofit organization, 501c3, and we started off as a podcast, but we drifted off into, becoming an official entity. So a lot of people do come here to play, and we do some things off the grid as well with individuals um, in our community. So what I would recommend, right? Anybody that's listening, in addition to what you said, because that's key sound advice, we really need proof that the people that you're going to partner with, right? They say who they are, right? We need to see their projects. We need to see HUDs, probably like proof that they actually were on transactions. And what are some other things that you would recommend that they look for as like proof? Because I feel like a lot of people are capping. If you don't know what that means,
I know that it's, uh,
they're lying,
but
right? Sometimes
yeah,
in cases.
yeah. I mean, I think word of mouth is a really really great and time tested way to understand who somebody is, right? Particularly, you should invest if you're a newbie investor. You shouldn't invest with a stranger unless that stranger has a big brand, right? Certainly you don't need to know Barry Sternlicht to invest with Starwood. You don't need to know Steve Ross to invest with Related. Um, but if the person you're looking to invest or partner with is somebody local and smaller with a track record, you need to talk to their former partners and understand how that turned out. I think looking at documentation and a lot of those things can be selectively disclosed. Um, I think that you can definitely research and certainly are able to research other people who transacted with that, other people who know them, take them to lunch. If you've had a bad experience, um, it's unlikely that you have some fealty to that person. You'll express a bad experience. If you had a good experience, you'll express that as well. And I think that's why your reputation is so important in this industry, because so much information is sort of diluted and complicated. The only thing or the most important thing that you've got is your name and your word, and the people who value that do exceptionally well, and they're able to attract capital, whereas the people who don't very much struggle when they raise equity.
That's that's very sound. That's very sound. Now, I love that based on what I heard and based on what I see, that you are speaking like like I don't want to say initiative, I don't want to use it twice, but you have been laser focused on affordable housing.
Yeah, I don't know if I'd say laser focus. It
Oh,
certainly is a focus.
right.
And I very much like working on affordable deals. I think they're very, very interesting. But we do everything out of this office, right?
Wait,
Market rate, affordable, luxury condos, hospitality, Class A office, life science office. I think your ability to be malleable across platforms is a big advantage, especially in the market of today, where there's so much uncertainty that you need to be able to pivot from asset class to maximize returns.
I'm glad you mentioned that because that was one of the questions. What is, in your opinion, what is the current state of the market? And
Right.
you're saying diversify yourself. Don't just be in one particular niche, such as affordable housing or A class. Spread yourself out and basically analyze the deal pretty much, right? Make sure it's a good buy.
We always everything allows to do. I think that when you're starting out, you need to develop an expertise. I think as you grow, in our company at least, we're larger. You're able to develop expertise across a broad number of asset classes, and that gives us an intrinsic advantage within the marketplace. I think if you're a small developer just starting out, that's bad advice. You should find something. You should have an investment thesis that is extraordinarily well researched, that you know inside and out. And in an ideal world, a market or sub-market, that you're a particular expert. I think that earlier on, a more sort of niche focus is advantageous relative to a broad focus. You have to know the market. That's a good question. I think we're at a time of historic uncertainty. You can see that as as of the recording of this podcast, Speaker McCarthy's been ousted as former Speaker McCarthy's bond yields are exceptionally wider. See rate guidance from the Fed. There's a new R-star. Rates are higher for longer. There are a number of hawkish Fed board members that sort of widening the dot plots. So I think from a macroeconomic perspective, we're at a period where there's conflicting data. Jobs reports continue to be strong. Labor force participation continues to be strong. Core PCE is reducing. So we're seeing less inflationary pressure. But we continue to see strong macroeconomic data. And the Fed is, to quote Jerome Powell, trying to navigate by the stars in a cloudy sky. So I think that from that macro perspective, the real estate specific perspective is very, very interesting. There's been a tectonic shift with respect to how we allocate space within city centers, in large part out of office, right, into multifamily. There's been a multifamily great net migration from high tax, low quality of life states down to low tax, high quality of life states.
Right.
And I think that that's coupled with artificial supply constraints in those low quality of life, high tax states like New York and Massachusetts that have made the production of net new units much more challenging. I think another big piece, and this is what makes the current set of economic conditions so interesting and unique, is that if you think back of previous recessions, right, the S&L crisis in the 90s, there was an immediate reprice of assets. The dot-com bubble, there's an immediate reprice of assets. The global financial crisis, right, adversely impacted real estate, but you saw an immediate reprice of assets. Where, obviously there's significant financial turmoil, asset values are reevaluated, and, the market then begins its recovery process. Here, because you have two or three, difficult elements that together are catastrophic, you have what I believe is a meaningful reprice, but it's happening incrementally, right? We've talked about the interest rate increases. So when the risk-free rate increases and the risk premium associated with owning multifamily or office remains constant or is even widened to some degree, cap rates move upwards. Obviously, the cost of financing moves upwards, and so the benchmark return necessary to justify an investment of any sort also goes up. That makes bricks and mortar pricing, right, because of supply chain issues and supply constraints, and the increased bargaining power of labor as a consequence of inflation, reduced labor force participation, right, means the cost of building stuff has gone up. the natural reprice has to happen in acquisition basis. Land costs have to go down. So you see this significant bid-ask spread between landowners and purchasers. It's very, very, very tough for folks to navigate. It's caused a significant drop in transaction volume. Now, these owners of legacy assets, whether they're existing office, existing multifamily, or land, benefited in large part from a rate regime that had artificially low interest rates. So their carry costs were very, very low. The term on those mortgages is ending, and what you'll have is a devil's bargain. They'll either have to sell the asset, which in some cases is worth less than the mortgage. They'll have to refinance with cash in because as rates have widened out, rent growth hasn't allowed them to keep the same debt service coverage ratio, and therefore meaningfully reduced the proceeds of the new loan relative to the old loan, despite NOI increases. They'll be in a tough position where we're to cash in refinance. And then obviously, the last piece for those who are severely distressed, it's not only their problem, but the lender's problem. Which means the lenders have loans on their balance sheets, particularly regional lenders, Signature Bank, the Flaster, now going to be acquired, is a great example. They have loans on their balance sheet that are underwater, which means they're significantly incentivized to either take the loss or to blend it instead if they believe in a long-term viability. You asset class of a submarket. What that does is reduce the volume for net new real estate loans. And it obviously creates an incentive to allocate away from commercial real estate whenever possible. And so you have less liquidity in the market. You have a significant bid-ask spread between owners of assets and their prospective purchasers, which at some point will ease downwards. But over how long and as a consequence of what paid in the marketplace, I'm not sure.
Right. I want to shift gears. I want to know who you are. And I'm sure everybody else know who you are. Growing up, what did you always know you wanted to be a real estate developer? As a child?
Yeah. I mean, whether it's nature or nurture, I don't know. But this is all I ever wanted to do.
Okay. What else?
My father, when I was young, my real estate education and my real education happened simultaneously. So when I learned how to carry numbers, I learned that on the P&L. When I learned long division, it's how I learned what a cap rate was and how to determine building value. My father was very intentional and deliberate about bringing me out in the business and arming me with a skill set to be effective. And I think that tells you a couple of things, right? The first thing it tells you is that real estate is not complicated. If a sixth grader can underwrite a building, so can you. You just need to add, subtract, multiply, divide. You just think in the right order. And the second thing it tells you is that access to knowledge matters, which is why podcasts like this one are personal.
I agree. And I love that your dad was molding you into this real estate mogul. I'm sure you're going to be a real estate, probably bigger than your dad. Who knows, right? But I love that the pouring came at an early age, at 12, or I'm going to assume sixth grade, you're probably 10, 12 in that range.
Yeah, I don't know whatever age you are.
Yeah, whatever.
2006 for me.
That's when I graduated high school. I feel old now. Okay. So I'll take that. But what I will say is, a lot of people who listen to the show, they may or may not know this. And it's not that I'm over the grief of it, but I actually got into development just because of opportunity. I just saw, I grew up in Newark, New Jersey. I saw Newark was a gold mine. Just to give you some backstory on me, I saw Newark was a gold mine, and the city of Newark was selling lots for $1,000. Mm-hmm. I'm like, hey, I want to be a real estate developer. I love the process in my head of, HGTV. They made it a really champion. However, we're now 10 years later, right? From the first time I ever said developer. And my dad was an investor for many years, but he wasn't a part of my upbringing. So it's so interesting. One of my friends just said, hey, you should try real estate. This is literally how I got into real estate. A friend recommending, because I was good in sales and I put myself through college working at AT&T. She said, you know what, try real estate. You can create your own schedule. And I became a realtor. Um, and making a long story short, I wound up becoming a wholesaler in real estate and then now a developer. But me being a mother of a 9-year-old, actually, I'm trying to like not force it on her, but say, hey, this is an option. Maybe you don't want to build communities like I want to, but maybe you want to build a theme park, right? I don't know. Who knows? Or a vacation destination location, but just putting, sowing the seed into her now, making sure she understands finances and money and investing and just building wealth at a young age is very, very important. So I just love that your dad instilled that in you at a young age. Um, so you mentioned underwriting, and this is just an impromptu question. What are some things that you're looking for when you're underwriting to know right away whether or not it's going to be a good deal or a deal that you will take on?
Yeah. I think, I think like anything, right? I mean, you have to analyze it.
Mhm.
It's like going on a first date, you have to get to know the person. You have to figure out if their values align. You have to figure out whether uh, you think you're compatible and that the investment of time that you're going to make, if that person will ultimately be repaid by the outcome that you're looking for, right? Uh, if you're searching for a long-term investment that ends in marriage and the person you're on a date with is interested in dating casually, then not a good deal. The same is true in real estate. You have to read with the underwriting. You have to understand the economic implications, the assumptions that underscore those economic implications in order to make investable decisions. You need to understand the market and the supply and demand dynamics, the tenant landlord relationship dynamics. You need to understand the OPEX dynamics, taxes, insurance, how you're planning on staffing. You need to understand hard costs. You need to understand the investment timeline. You need to understand the regulatory side, entitlements, permits. Um, you need to understand what the recent appraisal's been for the land or the building itself. You need to understand from an environmental perspective whether you're incurring environmental risk. Um, you need a holistic perspective on the asset in order to allocate capital to it. And so when you say, what are you looking for, uh, you know, when you first see a deal, I'm looking for everything that's wrong with it. Um,
That's good.
so that I can so I can very accurately understand my risk and the assumptions that I'll need to make in order to meet my target returns.
That's key. That's major. Because people, they're always looking at, all right, how much money I can make. Okay, but what is wrong? Why is it?
Yeah, but that's what I mean. I'm looking exactly for how much money I can make, and over what period of time, and what assumptions do I need to make in order to make the amount of money that I'm looking for. How viable are these assumptions, and what are the risk factors, or what are the things that could go wrong that would adversely affect my ability to make money in the timeline that I'd like to make.
Well stated, well said, because it's very important. Um, and what markets for those are you taking on new projects? I'm sure you're taking on new projects. Do
Mhm.
people still send you guys deals at this point?
They do.
Okay, so you're open to new opportunities. What markets are you currently looking at for purchase or for development?
Working, or I guess that's a great question. I think love New York, despite some of the sort of fiscal and quality of life challenges that they're having. I think Boston's relatively interesting, though there continue to be market headwinds, the life science space, and like a challenging entitlement process for large scale projects that serve as an artificial fetter to development.
Mm.
From a demographic standpoint, I love South Florida. It's market and wow, grew up in here. Um, I think it's extraordinarily interesting to see the net migration down to South Florida. That carries with it a certain your requisite level of intellectual capital that will inure the benefit of the city. I'd like to be on the cutting edge of that, getting east on inside transit Manhattan. It's hard to go wrong over the long term down there, though. I think that you've seen this big increase in demand, and now supply is starting to catch up. So rent growth, if you look for over the past 2 or 3 years, probably eases over the next 24 to 36 months. But over a long enough investment horizon, I think that South Florida is exceptionally interesting. It's inclusive in large part of the Gulf Coast, and they're benefiting from some of the same economic dynamics. Tampa, Arizona, St. Petersburg are really interesting. Texas is fascinating. Sharing and some of the big growth stories that ultimately will taper off. I think Dallas, Fort Worth, um, Austin, we've seen that taper. Nashville, and we're starting to see that taper as well. I'd stay away from cities that have crime-related issues or quality of life-related issues that seem to adversely affect industry. To some degree, New York seems to be insulated from that. But San Francisco, downtown Los Angeles, Washington, D.C., I imagine struggle on a going forward basis, but for certain pockets that are already relatively well established.
Yeah. It's so interesting. I was just in Washington. I was trying to go to the event that you were at, but I didn't make it. But I went a couple of days later because we're working on some opportunities there with another female developer. So that's awesome. But Washington, yeah, you're right. It's a lot of different pockets. Washington, D.C. It's hit or miss, but I do feel like it's being revitalized. It's not the Washington, D.C. from 10 years ago, or not even 20 years ago.
Yeah, I think a lot of neighborhoods in Washington, D.C. have been gentrified. I think there's been a ton of sort of younger professional with relative affluence. There are a number of those folks moving down to D.C. And, for lack of a better word, colonizing neighborhoods. The Wharf, H Corridor, Navy Yard, even historic Anacostia have seen significant demographic shifts. Um, and I think you've seen tons of rent growth in DC. I think the challenge, not only do quality of life crime challenges, I think that you have legislative challenges with respect. They make it very challenging to operate fraudulence. Latency and collection loss goes up. T-Core has huge weights. From an affordable housing standpoint, DC allocates a ton of money, on a per capita basis for gap financing of tax credits and its developments. Um, However, they've hit their bond cap now, so they're no longer able to create or allocate new 4% tax credit deals. And so the aggregate amount of new affordable housing that will be developed in Washington, D.C. will go down. Um, and I think a number of the macroeconomic drivers that are pushing people into DC dissipate slightly, but not to the degree that the affordable housing production erodes, which means that prices will continue to go up.
Right.
I think DC, to a great extent, but New York to a lesser extent, have a fiscal cliff that they need to be worried about. Obviously, with large scale commercial office vacancies, and the attendant foreclosures, you see an erosion of commercial values, which for both of those cities make a meaningful component of their fiscal budget. Um, and you could see what we consider like a fiscal do loop, right? Where property tax collections for fiscal revenue goes down. As a consequence, services are eroded. As a consequence, quality of life is eroded, which means that wealthy people leave, and businesses leave, which create lower asset value, which create less fiscal revenue, and the process repeats itself. I'm concerned. I'm concerned about the future of those cities in the medium to early long term. I think it's easy to bet on the seat of global power coming back, and we can be ambiguous with respect to whether or not I mean New York to see. But I think both of those cities had such strong conventional demand generators that over a long enough investment horizon, you'll see a political and social recalibration that will allow real estate assets to regain their value. But very much like New York City in the late 70s, early 80s, you may see a meaningful step back from the peak values that we saw in 2018, 2019.
Right. I love this. I feel like we're doing like a forecast.
Yeah, yeah. Well, I mean, that's my perspective on the market. And
Oh, I love it.
if you ask me where I want to be, right, it's a consequence of where I see those markets going.
No, no, no.
And
I
based
love
on
it. 'Cause you're schooling me because you're schooling me. You're making me think about stuff like I wasn't even thinking about. So I think it's great. I'm actually gonna name this development forecasters all different. I think like what you're sharing, um, pretty much probably is what MSNBC is sharing, right? But from a real estate perspective. So especially development, especially those who are investing their capital, they need to know this stuff. And I thank you for sharing. I just want to say that. So
wow, I appreciate it, right? And we have to, I think that you have to make data-driven decisions.
yes.
And you have to make decisions based upon a perspective that is a derivative of the data, right? I get frustrated when people say real estate values go up. Like, I guess so, okay. Nationally, real estate values increase approximately 3% year over year. Now, real estate values in Miami have gone up, but they've gone down in Detroit. Relative to 1950, real estate values have gone up in New York City. But if you stopped the clock in 1979, they would have lost money, right? And obviously inflation. The same is true, right, in Detroit. That was vibrant in the cities, and now is so meaningfully constrained and eroded. Cities have life cycles. Those life cycles are consequences of their sort of fiscal and sort of macro policy initiatives. And neighborhoods and submarkets also have life cycles that are a consequence of a variety of hyper-local factors, all of which I think can at some point be brought down to the level of incremental data. Having access to that data, synthesizing that data, and with ultimately deriving conclusions from the data, something we spent a lot of time doing here. That informs our perspective on the market, which informs our investment theses, and ultimately where our capital allocations go.
That's incredible. That's incredible. So your journey is a little different. However, what do you think is the most challenging? What are some of the challenges you face as a developer? Like with me,
Yeah, it's easy. It's easy. Just show up, everything goes perfect. There you go. That's awesome.
every investor developer has a different story, right? Like some are having issues with capital. That may not be your issue. So what are some of the challenges that you have faced in your career so far?
A ton. I think every project is a challenge. I made the statement where every deal dies 9, 10 times before it lives. And it's incumbent upon us to solve as many challenges in a row as we can. And at the end of solving those challenges, also we get to make some money, we create some assets that are very special and very transformative. I think that access to capital is historically always been a challenge. It's a challenge. Reason difficulties amplified as a consequence of the headwinds that we're experiencing in the market today. I think that navigating political processes from an entitlement standpoint has historically been a challenge. It continues to be a challenge today as political dynamics in a variety of different markets, or a variety of different states and counties and municipalities deviate, right, or move in directions that may be more challenging for us to do business. A fair amount of political risk that remains unquantified in the marketplace, and it's something that as developers, we're hyper cognizant of and concerned with. I think that the municipal priorities are changing, and may be at another inflection point soon, depending on the fiscal circumstances. And so in working with municipalities and in working with governmental organizations, like the Department of Housing and Community Development, that have finance agencies, staying on the cutting edge of those policies, is always a challenge. But I think anything worth doing is full of difficulty. Um, and so for us, when when the projects aren't easy and they're complicated, is an opportunity for us to demonstrate value. We thrive in complex circumstances. We thrive, in circumstances where the project's outcome isn't always clear, and where we need to bring sort of the full, bring our skills to bear in order to navigate through things that would otherwise seem difficult and near impossible. So, I mean, certainly not near impossible, but we like difficult and complicated deals. So we think we do well with this.
Okay. So what I will say is, if you ever need anything on the political side, I do have a business partner who is like a.
Oh, you can pitch on the podcast? Okay.
I'm trying to offer you.
Yeah, no, I got it. Okay. I mean, look, I think,
No,
on
I'm
the
not.
politics side, we do a lot of our work community ground up, right? And I think understanding what the neighbors want, understanding what the grassroots,
Mhm.
the people who are most immediately affected by the development want, is a driving force in how we orient ourselves in the marketplace.
Yes.
We think of ourselves, as developers, we think of ourselves as followers, not leaders, right? We don't want to tell the community what should go there. We'll learn from a community what it is that they need and solve.
Right. I was gonna say my partner, one of my partners, he is a retired city councilman in Kansas City, Missouri, but he's well connected throughout the country. He, helps with grants or whatever, depending on the municipality. So I don't mind, referring him to you guys if you ever needed help in a particular city. He's well known throughout the United States. That's what I was gonna say. But on my first couple of so I'm designated as a developer in the city of Newark and East Orange, and I think we're almost getting the green light with Atlantic City, but throughout the different cities in New Jersey, and then Kansas City, Missouri. This gentleman, and I know you're like, how did she end up in Kansas City, Missouri? This particular gentleman, I was introduced to him by one of my business consultants who wrote my proposals. Make a long story short, he brought me into a 200 townhouse development project just by meeting me and realizing what my goals were. And then he was able to get us $6 million in grants on that particular project. So you just never know. It might come in handy in the future as you navigate in different spaces, you know. Um, but no, that's great. And yes, the entitlement process, it can be prolonged for absolutely no reason. They can make you redo or make revisions over and over and over, and then you have to, pay additional costs to your architect. It all depends. So that is definitely a challenge for everybody across the board, development. And I think the last couple of questions I have um, would be, let's see, what is your advice for any newbie developer out there? And this whole dialogue has been a plethora of advice, right? But someone who's saying, "Hey, I really want to get into real estate development or investing," what is some advice you can give them to get started today outside of education? Because we know that you have to get educated for sure.
Yeah, get in the mix. I mean, I think it's getting educated and meeting people in the space. And you have to be scrappy, and you have to be creative. You have to be diligent. First impressions matter. Yeah, I can't tell you how many people send us deals that they'd like us to partner with them on, where they're relatively experienced and they don't do their homework ahead of time. They don't have they don't have robust underwriting packages done. They don't have offering memorandums. They don't have cogent or deal theses that are backed up by data. And you sit there and you say, "Look, this may be a good idea," but all of a sudden it's incumbent on me to figure it out. You're not bringing a meaningful amount of value to the table when you do that. And so I think it's getting educated, being in the mix, sort of having those relationships, or building those relationships. Then when you have an opportunity to take the knowledge that you gain and pair it with the people that you know, you need to put your best foot forward, and bring deals to the table that are well thought through, that have cogent investment theses that are well articulated.
That's really great advice.
And that's
I
something.
think a lot of people, when they first get into the industry, they have a lot of the social skills and a lot of the sales skills, and sometimes the technical skills, but being detail oriented is probably a component of this business that is the most meaningful in large part because it's the hardest to come by.
I agree. Yeah, I feel like even when people send me residential deals, which are a little bit easier to run numbers quicker, it's not well thought through, they didn't do their due diligence, then I'm like, listen, I don't have time to do the due diligence out there. So I agree with that. Well, thank you so much. I do appreciate your time for coming here to pour into this community. We love what graduate on everything that you're doing. And I pray that God will continue to bless you and your dad and everything the two of you are building. And that's pretty much it. Thank you so much. Let people,
Thank you.
yeah, let people know how to stay in contact with you or check out what you're doing.
Yeah. The easiest way is message me on Instagram. I do check my own Instagram, and I do check my own messages. So at Don_Peebles, I'll respond. I give you the address, my cell phone number, and we can talk.
Awesome. So everybody get connect. I'll actually put your Instagram link in the caption on YouTube. And everyone, make sure you subscribe to the YouTube channel and like, share this podcast. We're on all the platforms for podcasts. So that's Apple Podcasts, Google Podcasts, Spotify, everywhere, literally everywhere. So make sure you're listening, you're sharing. You definitely want to share this episode because this was like a whole masterclass today with our guests. So thank you again, Donahue. You have a
Thank
blessed
you.
day, and let's stay in contact for sure.
Sounds like a plan to me. Looking forward to it. Thank you guys so much.